Software as Service Weekly newsletter, the latest SaaS news from around the cloud. The SaaS era of 2013 to 2022 is over. Welcome to the world of hyperfunctional SaaS. So, is AI taking over everything? Will $1 billion SaaS companies be run by one person teams? I mean, maybe. Across the SaaS Star fund portfolio, I've seen multiple portfolio companies lose $1 million customers to new in house AI initiatives, but I've also seen others grow even faster as AI recruited and enhanced their products. What do I know is many of the billion plus SaaS companies I invested in a decade ago will not be remotely competitive today. And that's how it would be. Software, innovation, and time marches on. And if you can't keep up, you'll get left behind. Many today have been unable to keep up and have fallen behind and seen growth slow to 20%, 10%, even 0%. What I really think is happening is customer expectations have gone way up. AI is a part of it, platforms are part of it, and promises are part of it. Hyperfunctional SaaS, annual 2025 tickets will never be cheaper. Let's get you signed up. So we're already off to the races for planning for SaaS Star 2025, especially because we moved it back to earlier in this year, where it always was pre 2020. Okay, I won't read that part. That's just the promo part. 4 out of 800 sales execs raised their hand. 800 people, hypothetically, in the lobby. A new low in SaaS malaise. So we decided to do some folks a solid this year for a SaaS Star annual. In tougher times for many, job hunting is tougher, and in general, meeting the best of the best in SaaS and cloud IRL is more valuable than ever. Real value being met on the journey and the path. And then after experiencing something of a value, then we could log it and write it after. And when we pulled the 400 plus CROs, CMOs, and CCOs attending SaaS Star Annual, almost 100% of them said they were hiring. So we did something we've never done before. We offered all 840 plus of the past SDRs, AEs, and more than had done booth duty at SaaS Star Annual based in the SF Bay area a chance to come this year for a one-day pass, completely free on us. To actually experience incentive, to actually experience annual for real, not to just be stuck in a booth, to network organically. My insert. Meet hundreds of great VPs of sales, CROs, founders, and more. A gift, in my humble opinion. Literally every single CRO at a SaaS Star annual I talked to was hiring, 100% of them. What were they hiring for? You speculate that. SaaS Star annual may be relatively low cost compared to peer events, which today usually are priced 2x to 3x higher. And we also offer 50% off if you just buy early. That price, of course, may be out of reach to many junior sales execs. So we quietly reached out to about 840 of our past booth heroes and booth professionals. Admittedly, many might not still be in the SF Bay area, making travel tough, but if there's a will, there's a way. These are sales execs after all, and many took us up on the unprecedented offer that no one else ever does. To learn, to be hobnob, to network at an elite level? Question marks. 4. Yes, 4. You could read what you want into it, but I view it at least as one quantitative data point on the state of NUI and SaaS today. Only 4 out of 840 sales execs wanted to put in that energy to click on bettering themselves in their careers for free. And there's alternative side links within this very unique creative blog. Your core CAC versus your expansion CAC. One trophy, but 2 goals, objectives. There's a mistake I see Obviously, the collective different types of minds are there. There's um there's a mistake I see a ton of startups making today in the age of new efficiency in SaaS and pressure around making capital last. They are treating every customer the same for CAC purposes, and you just can't if you are scaling. What do I mean? Well, of course, the burn is the burn, and the budget in the end is the budget. If you have 2 million to spend this year on marketing and growth, then that's all you have. But what I see more and more these days is a lack of segmentation in CAC as you scale. For example, I'll see a startup just starting to take off at 2 mil, 5 mil, 10 mil, 20 mil ARR, and then start to cut back certain marketing initiatives because people are paying shitloads for advertising and marketing, and then start to cut back certain marketing initiatives. You got to find the right people at the start, right? It's not just entirely raw experimentation, but it could be certain sales initiatives, campaigns, even markets, because the CAC is higher than average there. But here's the simple thing that still many miss. As you expand into new market segments, new verticals, new buyers, your CAC will be higher there. And then shout out to the side links. How to build pipeline and GTM alignment in 2024 with Datadog's CMO, Sarah Barney. In the latest edition of SaaStar's Workshop Wednesday, Sarah Barney, Datadog's CMO, shares how to build pipeline and create alignment across sales and marketing. The CMO role at Datadog covers the usual aspects of marketing, including product marketing, corporate communications, events, partnership, marketing, and solutions marketing, building pipeline. Why I'm back to the SF Bay Area full time. So I'm back full time-ish to the SF Bay Area, as often quietly are so many leaders and execs I known for years, and that's its own metropolis, right? Of a different type of tech hub, epicenter. I spent about 60% of my time since lockdown in SoCal, 30% in Palo Alto, and the rest in miscellaneous. It wasn't to work at the beach. It wasn't for family reasons, but still, I, like many of us, went from someone who never felt they could leave the SF Bay to someone who, well, did. The SF Bay Area is back with its own, fluctuations, right? Within its general economy and how different types of approaches and flavors of tech are inserting themselves in the general reality, my insert. It's clearly the center of the AI boom, even if many are based outside of it, in Paris and elsewhere. Y Combinator is having a renaissance, with 4 batches of hundreds of top-tier startups being hatched in Dogpatch and SF. You gotta build yourself up, right? Most will stay. Even top European accelerators like EF have come to SF. Many VCs that for whatever reason left have returned. New York is great. SoCal and Miami are great places to live and okay for tech. And certainly there are segments of SaaS and B2B where SF isn't as compelling. Vertical SaaS and parts of e-commerce may be so well focused on other geos, for example, it's not worth it to be in SF Bay. But we're all kind of back, at least most of us. Rippling joins SaaStar Annual 2025 as a diamond sponsor. Theory of the Compound Startup, Parker Conrad's. We're excited to have Rippling as a first-time diamond sponsor for 2025 SaaStar Annual, May 13th through 15th. SF Bay already passed. Hope you guys hope that was a great time with the event setup and everyone just kind of keeping it clean, right? Security's there. There might be a bar fight for whatever reason, maybe not. You don't gotta put that on. We've had so many great times with Rippling execs over the years, from CEO Parker Conrad joining us for the first SaaStar Annual way back in 2015, to helping kick off SaaStar Europa 2023, and for CRO Matt Plank supporting us on #1 ranked CRO Confidential podcast and live at SaaStar Annual 2024. Let's watch video of the week: how to build a product customers love and drive nearly $1 billion in revenue along the way. and obviously, subtract whatever expenses and other miscellaneous costs there are within, accumulating that revenue and seeing unique, I guess, programs in how there's just like a tax reduction, right? Because there's niche programs and tax reductions, right? Because ultimately you're trying to fill yourselves with more currency, energy, charge flow of the money so you could keep producing it and quote unquote exponentializing that, right? Or something like that. In today's dynamic SaaS landscape of hyperfunctional SaaS, software as service, and the journey of building a product that customers adore while simultaneously scaling revenue to nearly $1 billion is still quite a feat. And then within the esoteric technological flavor of this channel is saying, maybe we're in the software, right? We're in some type of software within some type of quote unquote matrix, right? Whatever. During a conversation at SaaStar Annual with Jason Lemkin, founder and CEO of SaaStar itself, parentheses perhaps, and Andrew Bialecki, co-founder and CEO of Klaviyo, shares his insights and lessons in achieving this milestone. Shout out to the side links. Klaviyo is the most awesome SaaS company you probably don't know enough about, but they're a huge player in the e-commerce and SaaS space. They're bigger than HubSpot and marketing by ARR, period. By having huge market share and owning a specific space. Not only is Klaviyo a rocket ship, but it was also the first SaaS company to IPO in almost 2 years when it went public in September of 2023. It was a big milestone for the company and the markets as it had everything you'd want in a company going public. 39% annual revenue growth, 16% free cash margins, and 117% NRR. More on that here. Listen to the official SaaStar podcast. New episodes of the SaaStar podcast with SaaStar, Rippling, Datadog, and more. SaaStar 762, 761, and 760. How to build a product customers love and drive nearly 1 B in revenue along the way with Klaviyo CEO, etc. And those are just, I think that he's just like simplifying the subjects he recited in the previous mini blogs. Tweets of the week. To be a great CEO, you have to enjoy telling certain stories over and over again, sometimes 100 of times. So it's like the story always renews itself. The story always refreshes itself because the story of the foundational story is quote unquote the same, but it's remixing itself in alchemical, esoteric, transformative ways, and obviously in the artificial ways, and we could get lost in some type of lower energetic competition that polarizes us where we don't see the way of the nature or the God way, whatever. Two types of struggling SaaS companies: the ones where the CEO is out there fighting tooth and nail for real to re-accelerate growth and getting even more driven and aggressive, and the ones where you hear about how we are in a downturn. I'm there forever for the former. If the CEO doesn't seem at least a little bit intense, join a different startup. We're mostly buying all the same standard software. Exactly. That's the headliner for this email. And obviously, if this needs to be taken down because of some, unclarified, ironic, quote unquote, policy, then that's the learning curve of, humans having the ability to be informed of what is quote unquote correct or incorrect, mind the grace, or what is right or wrong, mind the grace. Why we are mostly buying all the same standard software. You could pause that on your own. Ramp. Actually, we're mostly buying the same standard stuff. HubSpot, Zoom, Slack, Zoom Info, and Carter. So there's a fundamental, back burner to what AI sits on, right? So if the back burner is already doing the all-in-one, and all the new all-in-ones are saying it's an all-in-one, and the root and the foundational one is the all-in-one, what makes yours so special when it's a very unique replication process? No condescension, just trying to critically break it down, right? So Ramp has its latest top SaaS vendors on Ramp out for October 2024. Ramp covers a ton of spend, but it's fairly tech focused in its customer base. So there's a bias there. But no matter what, it shows what its customers are spending billions on and what are the top 5 apps for its new customers. The same ones as it's been for a while. You know, who knows the particular time span? HubSpot, Carta, Zoom Info, Zoom, and Slack. Now, Ramp does also track breakout vendors. The biggest percentage change is a mix of cool new names, Cursor, Flow.ai, Replit, and a revival of some classics, MailChimp and Parallels. Still, a reminder, the giants of SaaS today are still the giants of SaaS. Go up against them for sure, but don't discount them. Not yet, not today at least. Buying patterns in the alternative side link. Most great VP of sales were fired once in their career. Most of the best VP of sales have been fired once. It's not always on their LinkedIn. They don't always bring it up, but it's part of it. Sometimes it's for a mismatch of skills versus opportunity. You can crush it one place and struggle in another. Sometimes for the best sales leader, it's a mismatch on passion. And that one time is often good for you. It puts a chip on their shoulder. So does being topped or passed over. But being fired once, even after they crushed it at their prior role, it produces drive. So don't run from a great VP of sales that was fired. Yeah, get it on lock, get it on go, get it on ready, set, go. Yo, are you ready for this next level flow? Yo, put it in drive, yo. Put it in drive, yo. Put it in that new clutch, put it in that new rush, put it in that new shift, new shift, new shift, new flow 4, new flow 5, new flow 4, flow 6, 7, 8. New flow 8, new flow 9, new, yes, yo, drop it like a decimal. This is beyond overly incredible, sentimental, no time to be emotional. Yo, new generational stuff. I'll be coming in like Osmosis Jones. So, Gerenio, yo, gotta clean me from the outside in to the inside out. Gotta clean that perennial for realio. Though I got you better know the dealio for realio. I just gotta be getting it in like a different type of I try to steal but I steal you and I feel you and I'm too ill for you. So don't run from a great VP of sales that was fired. Calmly dig in and learn and just make sure it wasn't every role. That most of the time they did crush it as an CDR, as an SDR, an AE, a director, etc. So don't run from a great VP of sales that was fired. Calmly dig in and learn, and just make sure it wasn't every role. That most of the time they did crush it as an SDR, an AE, a director, etc. The director. What story is the director trying to tell, etc. One misjump, one mistake though is part of the territory for a great VP of sales. A series of them is part of the territory for a mediocre one. The greats were fired once. SaaS Star Annual will return in May 2025. Yep. A big thanks to all who have locked in their super early bird tickets. The quiet liquidity crisis in SaaS, the collapse of M&A in software, M&A activity by the top 10 software acquirers by market cap, number of deals in contrast to aggregate value in the business. Theory Venture, and this diagram is provided by Theory Ventures. So Thomas Tunkus put together a great chart summarizing one of my top worries over the past 24 plus months in SaaS. He summarized the M&A acquisitions of the top 10 software acquirers. And then Quagmire comes to mind, and then Spangle comes to mind, and then that Pokemon that has a paintbrush comes to mind. And what you can see is there is really almost no liquidity for startups and scale-ups in SaaS and cloud at the moment, and there hasn't been for a while.
It was great times for SaaS liquidity in late 2020 through the end of 2021. Epic times. In SaaStar fund alone, we had billion plus cash exits in Sales Loft 2.4B, Pipedrive 1.5B, and Greenhouse almost 1B, among other deals. And 2021 was a record year for SaaS IPOs, and VCs didn't care if they got secondary shares, buying them from others, or new primary shares. So there were a ton of employee tender offers and buyouts going on. Liquidity was everywhere. It really was the liquidity crisis. Churn zero. 38% more customer success departments are reporting to the CRO period FBOW. Just had a Jace Lemkin says, just in all respects, in all honor and appreciation and gratitude, just had a check-in call with a 50K a year vendor we use for SaaStar. They sent a new sales rep to call who didn't know the account. They just walked through a deck with data they didn't collect or know that we'd already read. Read them and weep. What a waste of everyone's time. The death of the QBR. So a trend that personally makes me cry, but I do understand it, is customer success reporting into sales. It makes some short-term sense, especially when revenue slows. And this is when I see the change most often. When revenue slows, there is more and more pressure to grow revenue from the base versus new logos. And then sales more and more wants to own customer success and maximize the revenue from upsells. Upsells, not literally spell upsales, but upsells. I call it the weaponizing of customer success because, in my humble opinion, at least, and he put that in letters. How you say when you say a phrase and you put it into letters, abbreviate. I think abbreviate. I could be wrong. So he abbreviated, in my humble opinion. I call it the weaponizing of customer success because IMHO. We all gotta hoe our garden. At least it leads to a fairly terrible CS experience. Personally, every QBR and CS call I go to that is run by sales or account management or a CS exec looking for upsell is terrible. The meeting is never about solving my problems. I no longer go to them at all. Okay, but how real is this trend? Very much so, 38% more. 7 things I learned from Lauren Paddleford, CRO of 100 million plus ARR vertical SaaS leader slice. Woo. Last week's workshop Wednesday was with Lauren Paddleford, CRO of Slice, a 100 million plus ARR vertical SaaS platform for independent pizza shops. Lauren has been a SaaS SMB plus leader for years, running Shopify Plus and revenue leadership roles at Bill and Podium as well. And then mind the alternative side links. 5 interesting learnings from Zscaler at 2.5 billion in ARR. 5 interesting learnings from Zscaler. So Zscaler is a security juggernaut well known to everyone in the industry, but for whatever reasons, it doesn't quite get as much attention as outside of it. Wiz's epic growth and saying no to Google's 22 billion offer gets the attention. More obscure, but still important. Vendors like Darktrace get attention due to their founder. CrowdStrike got even more attention due to a bit of a patch mishap. But for folks outside of cybersecurity, Zscaler doesn't quite get the attention it should because it's epic. 2.5 billion in ARR, growing a stunning 30% still, 27% free cash flow margins, 26 billion market cap or 10x ARR, a wildly successful and committed repeat founder CEO who did it again, just much bigger. Growth isn't quite as crazy as it was at 1.5 billion ARR, 46%. But there's no downturn. But there's no downturn at Zscaler. 5 interesting learnings. Mind the side links. Speaker submissions for SaaStar Annual 2025 and Europa 2025 are open. We are gearing up. Yep, that's the promo to a new event. Let's watch the video of the week. State of the Cloud 2024, the cloud AI area with Bessemer Venture Partners. Every year, Bessemer Venture Partners releases a State of the Cloud report. This year, it's all about AI, which is why Shamir Zalakia, partner at Bessemer, calls it the cloud AI area. Four portfolio companies joined Samir to talk about three trends of the cloud AI era. And obviously, more tech specialists could inform us about like foundational code and the rudimentary software that is behind even cloud AI era, just on an inquisitive pursuit, right? AI foundation models, multimodal models, excuse me, change management. Julia Chapin, COO at Abridge, Kate Jensen, head of revenue at Anthropic, Rami Karabibar, CEO and founder at EvenUp, and Timothy Young, CEO at Jasper, share insights into this new wave that is changing everything about how we live, work, and buy. State of the cloud. Listen to the latest, the official SaaStar podcast, and I feel like he's summarizing the email at the end, more or less. 764, 763, 762. Tweets of the weeks by the lovely, beautiful Jason Lemkin. Founders have an incredibly annoying attention to detail. They see every typo, notice every time everyone is late, catch 10,000 bugs, remember every time anyone said they do something. It's not that they don't have anything better to do, it's just startups die otherwise. And shout out to all those people, those very, very particular people that have been viewing the online shit since, respectively, whenever there was a quality documentation and recordation of it. Most CEOs do not have time for a quick call, but most CEOs will read your email if it truly looks like it will help their company. So is it a value, right? Back to the basics. Is there shared value, trade value? Is it exponential value? That email truly awesome instead of asking for a quick call? And what is the best, number one best automation platform that compensates you for your original value with the financial archaeology of 2025? And that being instilled within all the hype of the cloud and the AI and whatever, new SaaS is there. If someone is trying to decide between joining your startup and something If someone is trying to decide between joining your startup and something like Salesforce or Adobe, let them go there. And there's the link right there. My best advice for CROs, VPs of sales that are ready to be CEOs. The emotional roller coaster of being a startup founder. So that's always going to be a challenge, right? That emotional roller coaster, no matter what position you at. That emotional roller coaster, it has to be checked like casually. And for some reason, within the balance of the logical approach, there is respect, so we can help each other's emotional roller coaster. Because no matter what position you're at, that emotional roller coaster will always be there. But if you've done some type of shadow work, and whatever shadow work means to you, then the emotional roller coaster could be, subsided, right? It could be kind of balanced. And obviously, other people can let that emotional roller coaster get the best of them, even in their profession. And then without them necessarily checking their emotional stuff, they don't necessarily see how they could make mistakes in their profession. But we all make mistakes. We all could, mess up, right? So I'm recognizing that type of shit, right? My best advice for CROs, VPs of sales that are ready to be CEOs. Many of my favorite VPs of scales are now becoming CEOs. Many, and I'm so happy for them within the red tape, pathway of, building a startup. Quotes. Many SaaStar OGs have pulled this off, and I'm watching many from Sterling Snow, CRO, and Divi joining Redo as CEO, to our own Brendan Cassidy, CEO at Hive Five, pull it off. I have one bit of advice though, as you watch them go from CRO to CEO. It's a much, 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 much bigger jump from CRO/VPS than you could ever imagine. And they agree. It's now all on the line. It's always been the same challenge, but it's just remixed and rehashed every year, right? We're always going through the same challenge of some type of, I guess, power control, right? And if there's not some type of DAO balance, then there won't necessarily be a proper flow within, the organization that you would like to build, right? Because the basic concept of teamwork, it has its own levels, even in its lesser compartmentalization of how something can have a micro compartmentalization to a macro compartmentalization, most respectively. So it's now all on the line, as it more or less always has been. My answer, whatever. And 95% of you have never actually shipped a production into production, committed code, dealt with a Sev1, or even know what a truly great CTO looks like. You could do it. Just realize it's 10 times harder than you imagine, maybe 100 times harder. But with the right team, maybe not. You want people, people are asking for these things, right? And the resonance needs to be correct, right? And the polarities of the matrix need to be recognized so the resonance can be correct and maintained and preserved, right? So we shall not underplay the resonance with this new shift of global teamwork. So we're not underplaying the resonance, the constructive positive resonance, and the constructive positive teamwork that's being focused on, right? So the fucking global shit could stop. It's like irrelevant, mishaps, right? And I'm not saying anything bad about any nation. I'm just trying to solve some real shit. You could do it. Shout out to all the beautiful people. Yep, you're beautiful. Yep, you're beautiful. Yep, everyone's beautiful. The 11th SASTAR annual will return in May of 2025. We just wrote up some of the sponsor and attendee data from this year's annual, and who knows where that summary is archived, casually saying it. But here are the top 3 learnings attendee-wise. Number 1, 57% of all attendees were VP level and above, so they did their work. We can't judge what we don't know. They put in their work. 57% of all attendees were VP level and above. So that's a good majority percentage. And I'm here, and I'm doing this as part of me learning, right? Because obviously, who's to say that I could even speak like this, right? I'm just what people need to realize is, even the Tao and other positive spiritual traditions alike is come in as something of an open mind, right? And obviously that's been dibbled and dallied here and there, obviously in a good way, right? But keep an open mind, right? But in the learning, what do you call that? The sector, keeping an open mind is also it's a thing, right? So should I close that? Should I close that window? 57% of all attendees were VP level and above. So there are a lot of different attendee data points that are interesting from hosting 10 editions of the SASTAR annual. But it's great to see this number go up YOY. It's by far the highest concentration of both CEOs and VPs of sales and marketing at any non-vendor B2B event in the world. So if you attended 2025, you're in good company. Point number 2, 44% of all attendees come as a team. 70% come as pairs. Who knows if it's a particular intern or not? Who knows but that's something else. We've seen this consistently now for the last 2 years, that the majority of attendees come in groups, with 44% of attendees coming as a team, i.e. 3+ or more attendees from the same company, and plus 70% of attendees coming with at least 2+ people from the same company. Number 3, within attendee groups joining as a team, at least one was an exec. So they're really dialed in with the classifications of the status they're reaching in something of a quote unquote red tape tech entrepreneurial industry, end quote, respectively. Maybe more interesting that 1.5 of those 3 from a team attending are at an executive level. On the attendee side, it's a point that more teams are coming versus solo individuals to help expedite decision making and in-person at events like a SASTAR annual. On the attendee side, it's a point that more teams are coming versus solo individuals to help expedite decision-making and in-person time at events like SaaStar Annual. The secretaries, they're evolving too, in their own, bookkeeping avenues while the AI is growing in its own respective parallel, right? Most respected. And let us, explore quote unquote original open source respectively, whatever. And yes, I am open to constructive criticism. All of this to say, if you're considering attending next year's annual as a team, now's still the best time to do so. Early bird tickets are always the best pricing and about $1,000 less than last minute tickets. So if you want to go for the least possible, now's the time. That's a promo right there. And it's like someone could ask, like, well, what experience do you have? Or like, I'm just showing up. And I'll let some other different angles of the data do its own proving if it needs to be proven, right? And obviously there's no, so like the tech world is needing some type of dream world, right? Because you can interpret angels as angles, right? So if angels are angles and different angles have different supplies of energy sources, and those energy sources are encapsulated in some type of pocket angle energy, and that has a more or less span bandwidth of a segue of a different type of consciousness, of a multi-proliferation of expression of energetic, different expressions of consciousness, then the angles are the angels, and the angels themselves have a new expression and definition of them that could materialize as an angle. And it's interesting that I brought up the angle, right? But so within the angles, then the unique different data infrastructure, big data sets could even have a correspondence with a certain type of quote unquote angel. So it's like the etymology has been passed down. Angel investors, they're coming from some type of pocket corridor of consciousness that has a new surface level expression, and that surface level expression is not good, not bad, focusing on the polarity of the artificialization of from where it came from, a foundational point of view of quote unquote energetic consciousness, right? Shotgun S. Pellegrino. Dear SaaStar, what role do founders play once they hire an outside chief executive officer? Let me take a slightly different take on the question. Maybe you are really asking, am I still on the hook if we hire a real CEO to run the company? Because I'm tired, stressed, don't really enjoy running this thing. I'd rather just be running product, coding, hanging out at events, whatever. So, we have to work up to the knowledge and the experience to earn these titles, right? We don't know what the titles entail. You have to be a multi-manager of these things, right? You have to kind of like wear more than one hat, but you don't necessarily have to, because like what in principal definition, in modern terms, what does a CEO do for a successful tech company, right? In modern terms, mind you. My learnings and experiences are this: if you want your startup to really make it, then you will be just as much on the hook as ever. This new CEO, no matter how great he is, does not understand your domain the way you do. Probably is more operational than strategic in terms of understanding the space. Maybe we'll never really see the future the way you do, only the present, and maybe can't see the cracks below 5,000 feet and won't know when and where and how to fix them. And people do that within realistic cases too of life. If you bring in an outside CEO and then check out or leave, you will be seriously damaging the value of your equity. You just know so much at this point because you had to do it all and learn so much, getting 10, then 100, then 1,000 customers, which is borderline impossible. There's a reason most startups don't get this far. So don't bring an outside CEO to get some rest. Only do it if it increases your equity value because she will make the company worth even more. Because if you want to win, you won't be getting any vacation if you leave sub 40 to 100 million ARR. The latest sponsor feedback and event trends from the 10th SaaStar annual. We recently held a post-event SaaStar annual executive debrief to share some of the latest event data and trends we saw across all 100 plus sponsors and 10,000 attendees of this year's SaaStar annual. A lot of this proprietary data is, I think, too good not to share, and maybe help even give you a gauge on where at least some of your compatriots in SaaS trended for an inside event at this scale. The average Super Gold sponsor received 470 qualified leads in 2024, up from 249 in 2023. And then mind the side link. 5 pros and 5 cons to taking a VC round at a very high valuation. The concluding tweet, if you are by the beautiful, lovely, gorgeous Mr. Lemkin, if you are lucky enough to raise at a crazy valuation, just remember you don't have to spend it at all. Keep the burn moderate and the downsides are muted. A lot of VC advice is a bit self-serving. Not necessarily wrong, but self-serving. Is raising VC capital at a too high valuation a bad thing? As so many VCs say, it's mixed. There are risks with a too high valuation, but also benefits. A high valuation isn't necessarily bad, it just has dangers. We're seeing a ton of that now with unicorns that raised at very high revenue multiples that are now unfundable. But like many things, it's nuanced. Dialpad is growing 50% at 300 mil ARR. Dialpad, we're growing 50% at 300 mil in ARR. Yikes, past 3 years, 23.7 NASDAQ, 31% S&P 500, 22.8% DJIA, minus 45.5% top cloud and SaaS stocks. So I would imagine it's a nuanced stock. So are we in a downturn in SaaS or not? It's confusing. On the one hand, many in SaaS and cloud are still growing at epic rates. Zscaler is growing 30% at 2.5 billion in ARR. Samsara is growing 36% at 1.26 billion in ARR. Klaviyo is growing 39% at 800 mil in ARR, and I'm sure there's new fluctuations updated to this, Intel data. Monday is growing 35% at 1 billion in ARR. Shopify is growing 21% at 8 billion in ARR. CrowdStrike is growing 33% at 3.65 billion in ARR. I asked Andrew Bialocki, CEO of Klaviyo, my opening question at SaaStar Annual, are we in a downturn? He instantly answered, not in our space. On the other hand, the public markets overall are tough. As you can see here, over the past 3 years, NASDAQ overall is up 23.7%, but the BVP Cloud Index is down a stunning 45.5%. Yikes. So it's confusing and all over the place. So it was great to see Dialpad announce they've grown from 200 million ARR last year to 300 million ARR already this year. That's more than 50% growth in less than a year at that scale. Wow, growing 50%, mind the side links. The 11th SaaStar Annual will return in May 2025. So there's a repeat of that blog. Dear SaaStar, when should I hire a head of customer success? You need a senior CS exec as soon as you have 2 big customers because you can't afford to lose them. So you need a senior CS exec. You have 1 million in ARR before then. So these are like something of an essential, right? Something of a need. You have 1 million in ARR. Before then, maybe you could hack it, and or you have 500K or more of renewals coming up. Not that different from prior point, a different way to look at it. And then obviously shout out, just everyone, I guess. Once you have even 1 mil in revenue, you are likely ready for a full-time customer success lead. Maybe too early for a head of or VP, but someone senior enough to own it. Maybe even once you have more than 2 or 3 big customers, then it can't just be part of your job or someone else's job. Staff one person for every few top logos if you can, and as early as you can. Watch magic happen over time, baby. We all good, baby. Hiring ahead of CS. The bar has gone up. The new era of hyper-functional SaaS with Jason Lemkin. It's here. The era of hyper-functional SaaS is here, and it's reshaping the landscape of SaaS companies. At a recent SaaStar Workshop Wednesday, held every Wednesday at 10 a.m., SaaStar CEO and founder JL lays out how SaaS companies are now faced with the challenge of delivering more comprehensive, automated, and efficient solutions than ever before. The bar has gone up, and it's not just in AI. Sorry, but there's no downturn, at least not in spend, and not outside of B2B tech customers. We have too many leads. Once we reach the disabling the shadow bands and we see a different avenue of truth, we have too many leads, and the sales team doesn't want to follow up. So I want to tell you guys something about a bit soul crushing. We had 20 plus of our top sponsors at SaaStar Annual this year tell us they got too many leads from the event. Too many. What? Be open. We've spent years trying to make SaaStar Annual, Europa, and APAC great for all 3 legs of the tripod: attendees, speakers, and sponsors. You need all 3 to be an A/A+ to really scale, and it's hard. Part of that is delivering hundreds of qualified leads to sponsors. You got to do it. Too many leads. There's that stat panel, whatever. Dear SaaStar, I don't really feel confident enough to call myself a quote CEO. Yeah, pretty common. We've all felt this way, myself included. The CEO of Atlassian shared at SaaStar Annual, he felt the same way, and that he was basically unemployable, feeling confident as a CEO. Dear SaaStar, why do angels invest even in if most of them fail? Because they're on their own life experimentalization path. And is a 10 times return event enough? Is a 10x return even enough? What are your quote unquote expectations, if you want to even use that word? You're right, 10x isn't enough. True angels invest so early, maybe only 2 out of 50 make any real money, sometimes just 1 or 0. If it's just one big winner out of 50 angel investments to even just double your money, that winner has to do 100x. So most successful angels in tech are seeking startups that could 100x their money. That's really 200x from the price they paid. Because typically over the lifetime of an investment, total dilution is about 50%. Wow. So if an angel invests at a 6 mil valuation, that's a 1 bill exit to hit 100x net of dilution. That's why everyone is hunting true unicorns and decacorns. The math doesn't work otherwise. It's tough math, it really is, especially for angels who don't get fees or salaries along the way. And you can also see why many angels that are in it to make money, for some, it is more a hobby. have trouble investing as the valuation climbs. It just gets harder and harder to see that 100x. Is it enough? The state of SaaS go-to-market with Theory Ventures general partner Tamazi Tunguz. When Mark Benioff started Salesforce, he codified the sales playbook. Then Mark Rawww, former HubSpot CEO Rawww, wrote the sales acceleration formula with deep insights into quota structures. For the subsequent 10 years in software, we optimized every little bit of how we sell it. But today it's different because the kinds of software we sell aren't the same. It isn't predictable. 6 months ago, security was the #1 prohibition preventing businesses and software companies from buying AI. Today it's ROI. TT, general partner at Theory Ventures, shares 9 observations from a go-to-market survey Theory Ventures did with hundreds of startups. 68% of them early stage, well-funded, mostly mid-market, ACV, and 25% remote. Here's what they found: the state of SaaS, mind the subleagues. Dear SaaS Star, how much should a SaaS company invest in professional services? Business outlook. The following forward-looking statements reflect Kalpa's expectations as of March 12, 2018. Guidance is based on the new revenue recognition standard ASC 606. First quarter of fiscal 2019, total revenues are expected to be between 51 and 51.5 million. So some type of, interpersonal, organizational, company GDP, respectively, whatever. Subscription revenues are expected to be between 46.5 and 47 million. This includes a negative impact of approximately 1.5 million due to there being 3 fewer calendar days for our revenue recognition in Q1 compared to Q4. Professional services revenues are expected to be approximately 4.5 million. Approximately 2 million of professional service revenues recognized in Q4 of fiscal year 2018 were one-time in nature. Non-GAAP loss from operations is expected to be between 5.5 and 7 million. Non-GAAP net loss per share is expected to be between 0.11 loss and 0.13 loss per share. Basic and diluted weighted average share count is expected to be approximately 55.8 million shares. A rough yardstick is that most enterprise-focused SaaS companies tend to get about 8 to 10% of the revenues from professional services. Wow. And that could be, explored and contemplated in a different avenue, obviously. Just like different types of unique data transcripts of exchange transcripts and, conscious financial archaeological transcripts and then communication transcripts and, agreement transcripts, contract transcripts, or whatever. A few data points. At 800 million ARR, Qualtrics was still getting 25% of revenue from professional services. At 500 mil ARR, OneStream gets about 8% of its revenue from professional services. CrowdStrike gets 8% of its revenue from professional services too and makes money on them with 27% gross margin. Okta gets about 3% of its revenue from professional services. HubSpot gets about 2.3% of its revenue from services. It's SMB. Bear in mind, for these leaders, third parties often do the majority of the heavy lifting here. HubSpot has a huge agency and a partner program that does deployments for 40% of its customers. Salesforce, similarly on the enterprise side, has built a huge ecosystem to do the services work for them. Nice. Oftentimes, changing more than Salesforce does itself, but this gives you a sense of what these leaders do internally, how much to advance, mind the side link. Explore Sage Intact for SaaS. Take an interactive walkthrough of real-time financial dashboards, automated billing, subscription lifecycle management, and advanced analytics specifically designed for SaaS businesses. Explore Sage. The 10 most popular SaaS star videos of all time. CEOs, Y Combinator, WordPress, GitLab, Loon, and more. So we finally crossed 50,000 subs on SaaS Star YouTube. It took a while, but I'm probably on the unparalleled quality of our content, especially the past 18 plus months or so where we stepped up the editing and more. So if you want to catch up, here are the top 10 most popular SaaS Star YouTube sessions of all time. No, I did take out a few that would have made the list, but were a bit dated. And I'll click that on my own time, and then maybe do a light review on that for the next one, right? One thing is clear: AI is leading to 1,000 new competitors in SaaS. So is AI truly disrupting every category in SaaS and business software? Is AI truly disrupting every category in SaaS and business software, and even like copyright sector delegations? It's clearly radical. It's clearly radically disrupted many categories, at least on one level. It's created thousands of new competitors, fueled in part by billions and billions of venture capital flowing into AI. And obviously, I'm not going to get esoteric in this conversation of the origins of AI. I've done that in the past, but I'm not going to go off topic here. And thousands of entrepreneurs excited to use AI to existing categories, because that's an esoteric technological flavor, respectively. And I'm not going to off topic, right? AI is creating new competition. Great VPs of sales never hide from a miss. If you are lucky enough to raise a crazy valuation, just remember you don't have to spend it all. Keep the burn moderate and the downsides are muted. We've talked a lot on SaaS Star over the years about how to hire a great VP of sales and how to course correct if you made a mishire. The two fastest to surface signs of a mishire. The two fastest to surface signs of a mishire. The two fastest to surface signs of a mishire. No one great joins them in the first 30 days. Every great VP of sales has one or two folks that want to follow them from their last role, and also has been quietly recruiting a few great folks anyway to join them at their next role. And the psychology behind that, who knows? That's a different study, right? The sociology within and out of the tech field, that's a whole different study, right? Great VPs of sales, even stretch VPs, are constantly networking to build the team they need both now and later. Nothing gets better in one sales cycle. You don't always need to see magic in your VP of sales, especially at first. Revenue doesn't have to double in one sales cycle, but you need to see things get better. Okay, but some of you will still give them more time. Even if they sort of fail the above test, your investors will probably encourage you to give them more time. You may not have to have the energy to deal with. Time and energy, not necessarily being emphasized, but could be, right? So let me tell you the number one sign a VP of sales just isn't going to make it. It's when they hide from a miss. They never hide. When growth slows, watch out for fake marketing on the team. Shout out to however AI is being categorized above tech companies in a different esoteric term. Shout out to the AI that detects the fake marketing on teams. What do you call that? Falsified evidence, right? So when growth slows, misconstrued, if I use that word correctly. So when growth slows, watch out for fake marketing on the team. What's that? It's stuff that okay, sure, is marketing and is often seemingly free or cheap, but won't move the needle. It's not what you need, but it takes a lot of time and fills the gaps when folks are otherwise out of ideas, energy, or both. Some examples of fake marketing: 99% of digital events, no one comes or shows up. But a huge amount of time and effort, and it feels like you are doing something that matters. But does it? We're not in lockdown anymore. No one wants to sit in front of their laptop all day and watch a boring digital event. Wow. Cheers to that. Yap. yet another podcast. Will anyone actually listen? But again, a huge amount of time and effort goes into these. Poorly attended side events. Want to do a side event at Dreamforce or Inbound or SaaStar Annual? Great. But if you can't somehow drive high engagement and attendance, don't pretend it's real marketing. Doing field marketing right often is a lot more work than just this. Mediocre PR. A little of this is okay. But hiring a PR firm and spending a lot of time on very minor placements gets you nowhere. Crappy AI content, crappy AI content campaigns. Sure, you check the box. Sure, they take almost no energy or work, but they don't perform. And like, you know, obviously the background data and the analytics are for like, you know, real registered SEO views. I'm sure there's different like channels for that, right? Too much LinkedIn plus TikTok and other social media. So mind the student. Too much LinkedIn plus TikTok and other social media. Yes, LinkedIn is great for B2B up to a point, but spending a huge amount of time here because you are out of other ideas isn't going to restart growth. If your shorts are getting 50 views, what's the point? It ain't going to move the needle, not at scale, especially. Watch out for fake marketing. Mind the new side link. Like on a different path, you know, there's different pockets of the present now moment, right? It's like things are always happening as they are, but then nature sometimes needs to isolate you for many different reasons, so you could go back to a new present moment, because those things, nothing's gonna stop a river going down a mountain, right? Nothing's necessarily gonna stop it. We're gonna convince ourselves that we can stop the river, and we're gonna try to tit for tat the fucking river. But guess what? The river is still gonna do its thing. And obviously that was a bad metaphor. Zuora goes private for 1.7 billion. Why is this good news for SaaS? Real-time CXO change. Zendesk, Zuora, Nutanix, and obviously edit this, and maybe, you know, someone, you know, I don't know how they will edit this in the future, you know. So yesterday, OG SaaS pioneer Zuora agreed to be acquired by PE to go private for 1.7 billion by GIC and Silver Lake. This is good for SaaS. CEO Jen Zhuo is an OG SaaS leader since being one of the very first leaders at Salesforce. Wow. Zuora was very... And I'm chilling. Zuora was very early to subscription management, maybe too early, 2006, and built a mature 400 million ARR business focused on enterprise subscription management and more. 416 mil ARR, 9% growth, 11% free cash flow margin, 104% NRR, 445, $250K plus customers. Wow, 445, 250K customers. So that's it right there. That's the particular quote unquote niche objective, right? It's doing some type of deal transaction process to close the prospect and having some type of advanced automation software for a particular type of clientele pool that facilitates them so you could get 445, 250K customers. So within any of this, like, you know, rhetorical inquisitional pursuit, I think that's one of the target lead paths, is closing a deal and having an automation transaction process platform, right? Respectively. So 1.7 billion is 4.25 ARR, and that's with an 18% premium to go private. %. So 1.7 billion is 4.25x ARR, and that's with an 18% premium to go private. Before, it was trading at 1.5 billion, so less than 4x ARR. That's not a huge multiple, and in that sense, it's a reminder that growth matters more profitably than today. But it's also great to see PE continue to believe that can reignite growth in SaaS and make 3x their money here. Good for SaaS. The state of SaaS go-to-market with Theory Ventures general partner TT. When Mark, okay, that's a repeat. Okay, he's recycling some of the mini blogs. 5 interesting learnings from Palantir at 2.7 billion in ARR. And I don't know if I'm like pronouncing that correctly, but so some cloud and SaaS stocks are on fire even now. Nuanced stocks, right? And then there is Palantir, the fire of the fire. It's up to 162% in the past year and is now worth 95 billion at 2.7 billion ARR. That's a jaw-dropping 35x ARR. Goodness. Why is Palantir the highest valued public SaaS and cloud stock? 2.7 billion in ARR, growing 27% and importantly re-accelerating. 22% free cash margins and now GAAP profitable. Customer count up to 41% year over year. It's the bright AI-driven future folks are excited about. Let's dig in. Mind the side link. Or mind the alternative, right? We have too many leads and the sales team doesn't want to follow up. Video of the week to watch. And obviously, I'll do the side links later if that is appropriate. Video of the week, approaching 500,000 customers. Woo! Effortlessly. We can do it. How to win in SMB with Bill, CEO and founder of Rene Lecete. In 2006, Bill CEO and founder RL set out to define a category around financial operations for small and mid-sized businesses, SMBs. Needless to say, he succeeded. Small and mid-sized businesses. At SaaStar's AI Summit during the SaaStar Annual, Renee chatted with SaaStar CEO and founder JL about how Bill has reached nearly 500,000 customers, 500,000 customers, and mind the analytics niche platform that's accounting for those million customers, whatever that particular platform is, or software and Intel data analytics service SaaS software is, and 1.3 billion in revenue. How to win in SMB. Listen to the official SaaStar podcast. New episodes of SaaStar podcast with Bill, Theory Ventures, and more. Tweets of the week by the beautiful Jason Lemkins. The beautiful, great, wonderful Jason Lemkins interviewed a college kid today for an internship. Said he was mainly interested in a strategy role in marketing. This is not a joke. This is 2024. And I'll read that. I won't read that part because it seems like hey, how long will the AI bubble last? The cloud bubble lasted about 18 months. How long will the AI bubble last? And may Google Gemini explain the contrast? Let's see what Google Gemini has to say about. Can you explain the contrast between the cloud bubble and the AI bubble? Let's see what you got, James. Can you explain the contrast between the cloud bubble and the AI bubble? follow up on that later. Thank you. That was really good. The cloud bubble lasted about 18 months. How long will the AI bubble last? Table 1, worldwide public cloud services, end user spending forecast, millions of US dollars. So SaaS and cloud are stronger than ever. Overall, per Gartner, SaaS spend is still growing 20% with an estimated total spend of a stunning $300 billion in 2025. Excuse me. And yet price increases. AI and the cloud leaders are taking up more and more of that budget. So times are also harder at the same time. For the first time, the average public SaaS company is now growing less than 20%. That's crazy, down from 2021. In 2021 into early 2022, the average cloud leader was growing 67%. That's so high. It's almost unimaginable today. It almost sounds like fiction, the AI bubble. Mind the side link. Great VPs of sales never hide from a miss. That one's recycled, quote unquote. The highest concentration of CEOs and VP execs at any B2B community event in the world. If you want leads, you want brand exposure, or you want to connect with your customers, the SaaS Annual is the #1 non-vendor event in the world, period. 10,000 people in person attendees, the highest concentration of both CEOs and the VPs of sales and marketing at any non-vendor B2B event in the world. 61% of attendees are VP level. We have a design of the stuff you want much of. Please, number one event in the budget, which we have got not traffic. Applied sponsor. Genesis files to IPO. Will 2025 be the year of the "it's just time" IPO? Question mark. So it's been a slow time in the SaaS IPO since the boom times ended in December 2021. There have been just 3 SaaS IPOs since December 2021. Klaviyo, OneStream, and Rubric. Okay, that's my epic voice. And I missed it. And all were strong ones at 5 million ARR or so, growing 50% or so, and that's it. But it doesn't mean there aren't plenty of good ones waiting, from Stripe to Canva to Databricks to Dialpad and more. There are plenty at 300 mil to 3 bill ARR with strong enough growth to IPO, and plenty more at 200 million ARR with maybe less strong growth that still want to IPO. The clock in the end ticks on liquidity, and it ticks faster for private equity based back to SaaS players. VCs want to get their money back in 10 to 12 years, ideally. Longer is suboptimal, but okay. Bootstrap founders can be patient as they want to be. But private equity hopes to make their profit in 4 to 5 years, ideally. And so private equity-backed SaaS companies may finally in 2025 say it's just time. It's just time to finally IPO in the Richter, original open source. Even if valuations have it back, it's just time. OneStream was arguably one of these, and PE made a big gain on the IPO. Others will have to accept much lower returns, at least for folks that invested in 2020, early 2022, hit it out the stadium. Genesis may be the first of a flood of these PE-backed SaaS IPOs in 2025. It just filed to IPO. 5 simple tips to quickly improve sales performance by the beautiful Jason Lemkins. If you never listen to your sales rep calls, especially the ones that are mediocre performers, you'll often be shocked at what you hear. Here are my 5 simplest ideas to quickly improve sales performance. They don't solve bigger problems, but they usually work quickly. Concentrate leads in those who can close. If you have a rep or 2 that just can't close, that doesn't work in the early days. Leads are too precious. Let them go. Not to save money, but to concentrate the leads you do have in those that can close them. Be more, so they're being like specific goal oriented or whatever. Be more involved with sales. Prospects and customers love to talk to the CEO. They love it. Be more involved in sales. Get down and dirty. Get hands-on. Get loose. Don't get too loopy with it. Or maybe maybe. If you get more involved, at least in bigger deals, you will close more. That's the path, right? A top mistake I see CEOs make is to scale back the amount of time they spend in sales once they hire a few reps. It doesn't work that way. You never get that time back. It's just the reps now do more of the grunt work. But if you still have to be out there Zooming with prospects and meet in person with the bigger ones, Stuart Butterfield did. Listen to their calls and Zooms and join more of them. You'll be shocked how poor many of the answers are from mediocre reps. Build them better collateral and get them more air cover. Most sales reps are pretty bad at building sales decks, tier sheets, etc. Most sales reps don't know how to put on a webinar for prospects and customers. Do more marketing for them. Put in a SLA in place. Make sure every lead is called back fast. Prospects inbound when they have a need. Deploy intercom. Get back to them ASAP. Get back to them right now, ideally. Time kills deals on all levels. Pay more per deal closed. Are you paying enough per deal? It's okay to overpay per deal in the early days when sales is harder. So looking for quality, SEO services. And obviously we all know about, shout out Fiverr. As long as the sales rep is profitable or even break even, that may be enough. Everyone needs to build up their confidence and earn a fair wage. Favor, whatever. Boost sales, mind the side link. 6 of the most common mistakes I see first-time SaaS founders make. What are the most common mistakes I see first-time SaaS founders make? Second-time SaaS founders make other mistakes. They think they know more than they do. They spend too much. They often struggle to do things in a new way. First-time founders have many positives, but they also make mistakes we tend not to make with experience. Here's what I see most often. The top 6 mistakes first-time SaaS founders make. Incomplete understanding of business model and how it will scale. Many first-time founders have a decent understanding of how to charge for their product. How do you charge for your product? But haven't really rolled it up into a strategy to get to 10 mil, 20 mil, 100 mil AR. So rolling up the strategy to get 10 mil, 20 mil, 100 mil. Target audience has to be unlocked. The automation software has to be unlocked. The clientele agreement has to be unlocked. The trust, the relationship has to be unlocked to get to 50 bill in ARR, right? Just a contribution, right? Focus and model often changes. What it takes to get to the first 10 mil gets figured out. Too cheap. Once you have something, cheap is good. Capital is precious. But then a time comes at 1 mil, 2 mil, 4 mil ARR when you have to let it go. You have to pay folks market. You have to hire those extra few reps that we don't really have needs for today. See, that's the thing with the new, quote unquote future of tech and AI, how we could come together with like-minded individuals. That's a different, beautiful thing, right? Do that extra trade show, hire those extra engineers. It's okay. It's okay to, disperse the grease, as, my intuitive self would say, disperse the grease. It resolves itself over time, but first times tend to lose a chance on the road from 1 mil to 10 mil ARR to grow even faster. We're all learners. Tough transition from micromanager to macro manager. Most second timers have evolved into macro managers. They know to hire the best folks they can, of course, and let them run. Of course, you're choosing who you're hiring. And you have to be really discerning with that, I would imagine. There has to be a discernment for that, okay? Most first timers these days are such amazing founders. They can code, sell, support, upsell, and even hack marketing. Most first timers these days are such amazing founders. They can code, okay. It's recommended to know coding. You know, did Steve Jobs know coding? Sell, okay. Let's see, you know, the situation you're at, and let's see your potential to set sale. Support systems, customer support, you know, HR's there. Is that unlocked? Upsell and even hack marketing. Hack marketing. Oh, okay. That they can do and continue to do everything. Even once they hire people to do those functions, but once you hire real VPs, you have to stop micromanaging. That's the thing right there. Stop micromanaging everything. It's like this is a team. It's a nuanced teamwork, guys. Like, and that's so funny to bring that fucking shit up because it's like when you micromanage, it's counterintuitive to the growth flow of the organization project, right? And if you're doing that more, you're contracting in not necessarily a positive way your organization, and you're shortchanging your way in the competition, right? So we're breaking down the critical thinking and psychology of how one can overstep their bounds and they can micromanage on an unwarranted level, right? Right, international new court of law, respectively. So obviously there's a nuance on this fucking shit too. They won't stand for it. Mediocre ones are okay with it, even prefer it. However, VPs VPs a stretch too far. Period after whoever, however. Related to the prior point, stretch VPs are great, but hiring folks that haven't done it at all doesn't scale past the ARR. Great. Hey, keep it up, guys. Do that. Do your path, guys. Do that path. I see these articles. I'm not gonna name the article that I just saw, but do your path, mofo. Capital hubris in quotes. If angel seed rounds are easy, I don't see this always, but I almost never see it in second-time CEOs. But first-timers that have an easy time raising after demo days don't grok that the bar goes up for each round. They also assume that existing investors will bail them out, and they often don't budget enough time for fundraising. Still at 4%? Because I put battery saver on this phone. 5 to 4, 12 to 8. So I got 8, 4, 8, 4, 8, 4. So I'll do. They also assume their existing investors will bail them out, and they often don't budget enough time for fundraising. Too much social media-based pattern matching. I know, and I get the replication, mechanism. Okay, I get it. Too much social media-based pattern matching. I know Palantir, Facebook, Datadog, Figma, Toast, Box, etc. are all great companies, but it doesn't mean an exec from there is a good fit for your 16-person company today. We can't help this, but get more advice on your senior hires, and then ignore it if you want, but just get it. Still, first-timers do just as well, if not better, than second-timers, and they are much more capital efficient. Not always, but often, and they lack the biases of second-timers. Basically, I only invest in first-timers. 6 most common mistakes, mind the side link. 5 more interesting learnings from HubSpot at 2.4 billion in AR. The top marketing strategies for 2025 growth with CMOs of Snowflake, LinkedIn, and Carta, respectively. Right now is one of the hardest times of the year for marketers. Most CMOs will be heads down wrapping up a year-end assessment and figuring out what to pitch for next year's budgetary spend to drive revenue. All while navigating an ever-changing environment of inconsistent metrics, lower conversion rates, and a rapid change with the adoption of AI and SaaS. And obviously, that could have a different flow, or it could be broken down differently. But I'm just reading the panel. A CMO panel consisting of the CMO of Snowflake, Denise Person, CMO of Carta, Nicole Baer, and the VP of Marketing at LinkedIn for Sales, Gail Moody Bird all answer Carolu Dietrich's questions. CMO and advisor formerly at Atlassian about all things growth for 2025. Top marketing strategies. Mind the side link. How to avoid a bad VC investor with SaaStar CEO and founder JL. We're obviously written up a lot about fundraising investing here on SaaStar.com, but time and time again, SaaStar CEO and founder JL has seen so many founders sign a bad term sheet based on gut instinct. Snap call, you can call it. VC celebrity or vibes, and while that may be fine, it's not enough. So you gotta wait, wait. Don't rush it. It's not enough because if nothing else, you're stuck with your investors for decades, for better or for worse. Don't rush this shit. All of the new hype, for all of the new ventures, for all of the new AI agreements, for all of the new projects and presentations, from a DAO perspective, wait, pause, spiritual pause. It's not enough because if nothing else, you're stuck with your investors for decades, for better or for worse, and then you're gonna need some real esoteric lawyers on some beyond all this shit. And I've already spoke about this shit, but I'm not gonna get into the esoteric technological sector of this shit, which is very viable in the fucking flow of the quote unquote hype of building the future. A bad investor doesn't come off the cap table until you sell the company or years after an IPO, and so much happens in that time, in that decade or more. So here are 8 signs to help you avoid bad investors. Mind the side link. Tweets of the week from the beautiful, awesome, great, amazing Jason Lemkin. In the end, it's not the competition. It's not the lost customers. In the end, it's not the competition, it's not the lost customers, it's not the market changes, it's not the venture funding. You could get past all that. It's the internal battles that wear you down. Wow, praise Jesus. The drama inside, not outside, the ultimate unforced errors. The ultimate unforced errors. Being human. Go tell your co-founder you appreciate them. Go give your best VP more options tomorrow. It's all about options. Let fucking, balance AI with nature and sovereignty, consciousness, whatever the fuck that is for you. Give us sovereign options. So there's a particular esoteric technological stream that, not good, not bad, the polarization of surface level AI consciousness could overlook. Mind the original open source. Go tell your co-founder you appreciate them. Go give your best VP more options tomorrow. Go say thank you. Go apologize. Apologies are free. Lead from the front. Backfill the great but flawed. Let them run. Trust the best. Move on from the motherfucking rest. And I won't read this part because it seems like it. I'll read one more. My batteries are kind of like. This one's short. A lot of great sales leaders just aren't great at selling anymore, and why you really need a VP of sales and not a CRO. I'm just gonna read one more because it's like, oh wait. So this isn't a subtweet or a subpost. I'm not talking about any close friends in sales here, but there are a ton of folks I know that I used to be great in sales, but not anymore. The other day, someone who used to be an A+ sales leader emailed me about a position I'd introduced to him as a super hot startup. The email to me was, what do they do again? I mean, laugh if you want, but he used to be great. Maybe not epic, but really a sales leader I looked up to. Almost too smart for his own good, but great. I made intros and connections and put him on stage, but it doesn't matter why. He's not that today, and you just might want to hire him because his LinkedIn looks great and he knows process and the talk, but he just isn't a great seller anymore. He's done selling and probably being curious. When you hire the perfect resume, make sure they still are too. If he doesn't even exactly know what an A+ company I introduced him to does, He's just looking for a soft landing place. Your startup almost certainly isn't a soft landing place. No matter how much you raise, you need a seller. Mind the side link. How leading SaaS platforms have adopted embedded payments. How 3 SaaS CFOs adopted embedded payments. Adyen. CFOs from SaaS platforms in the insurance and legal industries reveal how embedded payments are transforming their revenue streams. Access interviews. Laters. Try to make one big VP hire a quarter. So recently we did a deep dive with Henry Struck, founder, CEO of Zoom Info, on AI in sales and so much more. We've done a series of incredible, highly operational conversations with Henry over the years. So I turned the convo around to ask him about a topic I still wonder about and struggle. How do you continually recruit VPs and C-level execs forever, again and again? I find that the hardest part of all this to constantly be recruiting the best, not just here and there, but constantly and again, because if you go long, maybe many of the best will eventually leave. So people need to interpret my purpose doing this before they think I shouldn't, before they think, something might happen, but maybe obviously it might be advised for me not to share this, but like I'm only sharing it for a time being because, in the future, it might not be like, it's like, it might not be like always readily available, right? I'm going to paraphrase his answer, but I 100% agree with the right one. Do it all. Do all the interviews, etc. But make sure, if nothing else, you hire one senior exec a quarter. Force yourself to do that. Focus there and prioritize on the most critical VPs, SVP, execs in that quarter. So maybe 4 of each, something like that. Dear SaaStar, what for the quarter, right? Maybe even 8, right? So for every quote-unquote need of a quote-unquote startup, because obviously within the syllabus of startup, they're going to say like all the different position needs that need to be filled. Maybe you could kind of like, express, 8 per year or 4 per year or something else. Dear SaaStar, because obviously I'm just flowing with like how people are interested in this shit, right? Dear SaaStar, what's the number one reason you see sales reps fail these days? The number one reason I see sales execs struggling today in the role, they are convinced their playbook is better and refuse to run the one that is already working. They are convinced they know better, that the founders are wrong, or whoever is running things is either wrong or to be ignored. That's not the way I do things, or some variant is something I often hear these days. It's not that they don't sometimes have a point. Every startup is deeply flawed on many levels. Smiley face, period after the smiley face. Maybe he just got done eating some pudding and there's pudding on the smiley face because the period is after the smiley face. And yet, the successful ones still find a way, and you have to run their playbook 9 times out of 10 to succeed in sales, not yours. Run their playbook. That's why you hired them. And so I see these seasoned sales execs blow up 30, 60, 90 days, and when they get frustrated, when they are pushed to run a new playbook. I can't imagine going to Salesforce or Oracle and joining as a sales exec and insisting on running your own playbook, but I see it all the time at startups. It's complicated. You are being hired in part for your experience, but maybe not in the way you think, Add on to what's working. Don't accidentally or intentionally do an end run around it, or you may end up bouncing out of a role that could have been great at. The number one reason. Solve SaaS sales tax with OnRock. Sales tax non-compliance costs the average SaaS business 5% of revenue. Get ahead of your liability with the sales tax platform built just for SaaS. How to fire a good client. We all sort of know how to fire an underperforming employee. Sort of. You let them know kindly, with care, and move on. But how do you fire a good client? One that has been paying regularly for an extended time that counts on you. It happens. The reality is, for service providers, you only have so many slots. Some clients are just too demanding. Okay, that's a different, you could like really, that's a whole conversation. That's a big conversation around that. About like, your needs and residents, whatever. It's easier to have clients that are less demanding. And sometimes if you do well, you just plain end up with too many clients and you have to let some go. So you have to increase the bandwidth of clientele and the expectations, right? Right? Custom email, Google, 2025. Maybe edit that part out. The ones that never pay, that's easy. Okay, cancel. The ones where you don't do all that much for, you just wind it down. But what about the clients that depend on you? I've had a few of these conversations over the years at law firms, accounting firms, and marketing agencies where after a few years, they want a less demanding client than me and or SaaStar. I had an accounting firm I used for years not want to work with us anymore, for example, when managing our taxes got a little more complicated, and a law firm not want to work with us when we decided not to get as big as A16Z, etc. Mind the red tape, logistics. All I can tell you is I just don't see agencies think about this much at all from the client's perspective, finding a good client. Dear SaaStar, what really happens when a company buys another one? The real work starts. A founder's guide to selling your startup. The real work starts. Having been through 4 acquisitions in different forms, founder, exec, etc., it's a lot like a venture capital investment. Usually there isn't actually a ton of time to really get to know each other first. Not really. A ton of time is invested negotiating price. And then way too much on inconsequential legal terms, and then it closes. Oftentimes, very little true operational planning is done on what to do after. So maybe like, new, whatever, like automation platforms that are, I guess, ubiquitous and provocative and, prestigious have that covered where post-operational planning is covered for selling startups or selling organizations or selling, whatever, right? It will all seem super important to you, but from the acquirer's perspective, they also have a core business to run, and each of the VPs already have a lot to do. They only go so deep in figuring things out all before the deal closes. What happens? So that's a free one, just to present you to my style, speaking, informative speaking, learning, speaking, tech, right? What really happens when a company buys another one? What happens? And then mind the sideline. So all of this unique blog intel, I will give credit where it's due, for for the scholarly, notion approach of it. Those blogs were written by the wonderful, beautiful, great Jason Lemkin. And thank you for this education and this build, this unique creative build. I appreciate that. I will resume that in a different time. And you, that's nothing. Let me see where I left off. Should I do one more? Thank you guys. Beautiful. I'll come back, with a different book, more songs. I could do a freestyle song.